Hello, my friends. Today is May 4th, and this is Markets Weekly. So, this past week was another roller coaster week in markets, but we did end the week up. And I continue to be positive on the equity markets, so let's see how that turns out. Today, I want to talk about three things. First, we have to talk about the big data point of the past week, the non-farms payroll report. But in addition to that, we also got a lot of other data on the labor market as well. So let's give an update as to what's going on in the US labor market. Secondly, this past week, we got the quarterly refunding announcement, which is when the Treasury tells the public how it's going to finance itself. Now, the QRA was not market moving, but it's always interesting. So let's debrief what happened there. And lastly, now we've talked about the yen a few times in the past, but it looks like finally, this time around, the Ministry of Finance put their money where their mouth is and actually intervened not once, but twice in the market this week. So let's see what happened. All right, starting with employment data. So the big data point of the past week was the non-farms payroll print. Now we've gone over this a few times in the past. So as you guys all know, we got to look beyond the headlines. Now looking at the headline print though, starting there, the headline print was fewer jobs created than expected. So that was a disappointment. But looking deeper, it continues to be a disappointment. Looking at average hourly earnings, again, lower than expected. And looking at the unemployment rate, again, higher than expected. So all in all, it was a weak print following a series of stronger than expected prints. The market took one look at this and knew exactly what to do. Now, the market priced in more chances of Fed cuts, and the equity market, of course, likes rate cuts, and so it went to the moon. The dollar also seemed to weaken a bit as well. Now, there are people thinking that, well, maybe this suggests that the economy is slowing, maybe we go into a recession and that's bearish. But in my experience, rate cuts are much more impactful when it comes to equity markets. Now, in addition to the big non-farms payroll print, we also got some other labor market data as well. Now, we got JOLTS, which tells you the amount of job openings available in the US. The higher the JOLTS, that means there's more demand for labor because there's lots of job postings. Now, over the past few years, JOLTS surged after the pandemic, but has steadily been moderating towards pre-pandemic levels. And we can see at a per job seeker basis, JOLTS is moderated a lot and approaching its pre-pandemic levels. So again, it seems like the labor market is softening. Now, one other data point that I think the Fed has been focusing on a lot is wage growth. Now, this past week, we got the Employee Compensation Index, which is the Fed's favorite measure of wage growth because it takes into account things like benefits and the composition of the labor market. Now, the ECI printed higher than expected. Now, usually you can think of this as inflationary because if you have to pay higher wages, maybe you turn around and you pass that through to higher consumer prices. But that alone, though, is not itself inflationary. For example, maybe wages are higher, but productivity is also higher as well. Let's say I hire someone to work at a factory and I give them $100 an hour. Okay, let's say a year later, I paid the same person $200 an hour, but they're actually making twice as much stuff as before. So per unit of production, it's actually not more expensive. Now, we also got productivity figures for the past quarter, and they were disappointing. So all in all, we have higher wage growth, lower productivity. Together, it's an inflationary mixture. And that did lead to some reaction in the markets, but ultimately, it seems like the non-farm payrolls print was the dominant force. Now, if we continue to go forward with weaker employment data, I suspect that the market is going to price in more and more rate cuts. And that's what I'm going to write about this week, how one path to get rate cuts, aside from slowing inflation, would be through the Fed's mandate of full employment. Okay, the second thing that I want to talk about this week is the quarterly refunding announcement. Now, this QRA was not market moving, and I don't think many people expected it to be. Now, the last year, the past two quarterly refunding announcements were market moving because they surprised the market in their amount of expected debt issuance. So, Treasury markets interest rates, like anything else, obeys the laws of supply and demand. When the Treasury surprises the market by selling more debt than expected, again, higher supply means lower prices for Treasuries, which means higher interest rates, and that's what we saw last year. But at the last quarterly refunding announcement, Treasury very clearly telegraphed to everyone that they're going to increase coupon sizes one more time, that is to say, the past week, and then going to hold sizes for the next several quarters. And so, because the market already understood that coupon sizes would go up this QRA, but probably stay around this level for the next few quarters, it was not a surprise. And that's exactly what happened. At this latest QRA, the Treasury again affirmed that it doesn't expect to increase coupon sizes for the next several quarters. So I would expect the QRA to be very uneventful for the next year. But the QRA does more than just announce to the public the financing plans of the Treasury. Oftentimes, they also include these interesting presentations based on topics of interest. So we get to see what the Treasury is interested in. So there are two presentations this time. One of them was the introduction of a benchmark 6-week Treasury bill. So right now, Treasury bills come in standard sizes, 4 weeks, 8 weeks, 13 weeks, half a year, and so forth. Right now, Treasury wants to introduce a new one that's going to be 6 weeks in tenor. Based on their research, that seems to be a sweet spot because money market funds would want to buy it. It doesn't impact their WAM, their weighted average maturity constraints too much. And 6 weeks seems to be about the length of time between Fed meetings. So if you were buying a 6-week bill, you would have less concern that maybe the Fed would suddenly hike rates or cut rates and thus give you mark-to-market gains or losses. So in a sense, it would be less sensitive to Fed meetings, meeting to meeting. So it looks like that's going to happen. And the second presentation was the Treasury trying to brainstorm what additional Treasury products they could put out. Now, historically speaking, the Treasury periodically goes into these brainstorming sessions, and new products sometimes arise out of it. Looking at this chart, you can see that in the not-too-distant past, the Treasury brainstormed about floating rate notes and indeed launched them shortly after. Now we have 2-year floating rate notes that are indexed to the 3-month Treasury bill yield. Now, it seems like the two top ideas coming out of this brainstorm session is first, callable bonds, and secondly, green bonds. A callable bond would simply be a bond that the Treasury could buy back in case interest rates decline. It'd be like a mortgage, right? So if you have a mortgage in the US and then mortgage rates decline, you can refinance it at the lower rate. So a callable bond would be like that for the Treasury. The interesting thing is that the Treasury actually has issued callable bonds in the past. So if they did again in the future, it'd simply be a return to something they've already done before. Now, something totally new that they're also thinking about is maybe green bonds. Now, green bonds, as we all know, it's probably going to depend a lot on who ends up in the White House, but green bonds have been more and more popular with investors due to the ESG craze. We even see many other foreign governments issue this. So maybe the Treasury would take advantage of the craze and issue some green bonds. Again, this is completely a political decision that would depend on who's in the White House. Now, the last thing that I'll point out in the QRA is that you always want to look at this chart in particular. What this chart shows you is the expected fiscal deficit for the foreseeable future, as well as how much financing the Treasury is getting if they keep coupon sizes constant. So as you can see, given the expected deficit and the current coupon sizes, Treasury is going to be well financed for another year. So that's why the Treasury doesn't think it needs to increase coupon issuance. But beyond that, though, based on the current expected deficit and the current coupon sizes, the Treasury is going to have to increase coupon sizes again sometime next year. And when that happens, it's probably going to impact markets simply because markets want to know just the size of the expected increase and where along the curve the increases come, where increases in, say, the 30-year or other longer dated tenors will have bigger market impacts. But that's next year. So for the foreseeable future, I'd expect the QRA to be pretty boring, or at least uneventful. Always interesting, though. Okay, the last thing that I want to talk about is the Ministry of Finance intervening in the currency market. So just to level set a little bit, over the past year, a bit more than a year, the yen has been depreciating significantly against the dollar. The driver of this depreciation is no secret. In Japan, they recently raised rates, but they raised from negative to zero. On the other hand, in the US, we've been increasing interest rates, and interest rates are about 5.5%. So if you're an investor in Japan, obviously you want to move out of the yen and into dollars where you can get a high return for your cash. So that's been leading to a pretty strong depreciation in the yen. Now, the authorities in Japan are aware of this, and they are okay with a yen depreciation, provided that it happens in an orderly way. So over the past few weeks, the Ministry of Finance over there has been giving stern warnings, trying to talk down speculators, telling them that they don't want the yen to continue to depreciate in such a rapid manner. That seemed to scare the speculators a little bit, but they immediately realized that this Ministry of Finance guy is all talk and not doing anything, and so they continue to push the trade. On Monday, we saw the USD JPY reach as high as 160 yen to the dollar, which is, multi-decade highs. Now, that 160 level seems to be the line in the sand for Japan, and the Ministry of Finance seems to have intervened. In a short period of time, we saw the yen appreciate rapidly against the dollar. Now, many rumors. It seems like the market is coming to the consensus that the Ministry of Finance intervened. Now, on Monday, that was also a holiday in Japan, so liquidity was thin. It would have been a very good time to intervene, because when liquidity is thin, for a given amount of dollars, market price moves a lot more, so you get the most bang for your buck when you intervene when liquidity is low. But as we can see in this chart, as the yen appreciated rapidly, in the next 2 days, it began to depreciate again. And so that seemed to prompt the second intervention from the Ministry of Finance on Wednesday after market close. Again, after market close, less liquidity in the US session, and in Japan, they're all sleeping. Again, a good time for the Ministry of Finance to intervene. This time, though, the yen strengthened a lot and seemed to stay strong for at least the next 2 sessions. Now, I don't know if it's going to remain strong. I suspect it won't, simply because the interest rate differentials are so large. But over the week, though, the interest rate differentials did close a little bit. Now, the FOMC meeting and non-farms payroll print led the markets to price in a little bit more chance of rate cuts this year, and so we can see that in the 2-year note yield, which declined notably this week. So that seems to be giving the yen some support. In the future, if we continue to have weak employment prints, or if the markets continue to price in more rate cuts, I think that will continue to narrow the interest rate differential and go a long way towards, strengthening the yen, much more so than any intervention can do. But let's see if that actually happens. Now, the market participants are speculating based on reports that the Bank of Japan, so the Ministry of Finance, along with the Bank of Japan, probably spent about $160 billion US worth to intervene. Now, one way they tried to piece this out, again, a lot of this is speculation, and we won't know more until more official data is released, is by looking at Fed weekly data. So Japan, being close friends with the US, keeps a lot of its dollars at the Fed. Now, usually foreign central banks keep their dollars either in the form of treasuries held in custody at the Fed, or in the foreign repo pool, where it's basically like an RRP for foreign central banks. They get a good return, or as unsecured deposits, basically like a checking account. What we see in the official data is there was a decline in the foreign repo pool, followed by a rise in unsecured deposits that subsequently unwound. So it looks like what happened is that the Ministry of Finance, again, they direct policy. Bank of Japan is probably where the person who actually keeps the money took money out of the foreign repo pool, put it in their checking account at the Fed, and then withdrew it to intervene. But we'll know more as more official data comes out. So one last thing that I'll go over is that this is definitely not a currency crisis. I go over a number of examples of that in my course, Markets 101, but usually looking at, say, Thailand, for example, a currency crisis would happen if a country has a lot of foreign currency denominated debt, and then their government is not able to support the currency. So in the late 1990s, a lot of Thai companies bought a lot of dollars, and the Thai currency began to depreciate uncontrollably. Now, the government at the time didn't have enough foreign reserves to protect their currency, and so they had to let the currency go. All these companies that borrowed in dollars then saw their debt burden increase significantly, so there was a huge solvency crisis as well, and that all ended very badly. In the case of Japan, now their government has tremendous amounts of foreign reserves. They can support their currency, not indefinitely, but they can definitely provide a lot of support if they wanted to, or at the end of the day, they could always adjust their interest rate policy. Now, looking at the balance sheet of companies there, I'm sure there are companies there with dollar-denominated debt. But also, though, Japan has tremendous amounts of foreign currency assets. Again, Japan is a country that has a large current account surplus. Every year, Japanese companies are selling lots of stuff to the US and to other countries, earning a lot of foreign currency, and then reinvesting that in foreign currency assets. So they don't have any solvency concerns on account of a weaker yen. The Ministry of Finance just doesn't like disorder, and I'm sure many people in Japan are complaining about rising import costs as well. All right, so that's all I've prepared for this week. Thanks so much for tuning in. If you're interested in my thoughts, check out my blog at fedguy.com, or if you're interested in learning more about markets, check out my online courses at centralbanking101.com. Talk to you all next week.